Well, it's safe to say I never thought it would come to this. I woke up to an article yesterday morning about a hedge fund that completely shut down. Yesterday, the news broke that a hedge fund called White Square Capital would be completely shutting down its main fund and returning all the remaining capital to investors, citing double-digit percentage losses reported by the Financial Times. Within minutes, it was all over the internet, and every major financial reporting outlet was talking about White Square Capital. In the article, it was revealed that White Square Capital had been one of the short sellers betting against many of the so-called meme stocks that came into the public eye late January of this year. To start the story, we have to rewind all the way back to January of this year when companies like GameStop, AMC, BlackBerry, and a few others became headline news because they had been revealed to be targets of massive Wall Street institutional capital taking bets that the companies were going to completely fail and that their stock prices were going to shatter. Now, unless you live under a rock, you sort of know what happens next. Basically, a bunch of retail investors banded together through Reddit on a forum called Wall Street Bets to try to put the pain to these massive institutional short sellers who were trying to drive these companies' stock prices through the floor for their own financial gains. Ever since January, what we've seen is a battle between these retail investors on the internet and these institutional hedge funds that control billions and billions of dollars worth of capital. And personally, I never thought we'd still be talking about this at this point in the year, but this is a major shakeup and could be one of just the very first dominoes to fall. So back in January, GameStop was trading between $15 and $20 a share, and AMC was at like $2 a share.
Thought you were dead. GameStop. My death was greatly exaggerated.
By the end of the month, GameStop had skyrocketed above $300 a share and AMC peaked at around $20 a share. And to be honest, even though I was rooting for the retail investors, of course, I never thought that they could sustain prices that high for as long as they have. Today, if you look at the stock charts, you'll see that since then, basically GameStop has not fallen below $150 per share for any sustained period of time. And over the past couple weeks, AMC has been between $50 and $60 a share consistently. So obviously, for the huge institutional investors that are betting millions, if not billions of dollars against these companies, that means a lot of pain and huge losses. Of course, White Square Capital is not going to admit that this short selling is what caused them to shut down the fund, but what we do know is that prior to them shutting down, two of their major investors pulled out all of their capital, and that they did in fact sustain double-digit percentage losses because of betting against these so-called meme stocks.
When you buy 0.03 shares of GameStop, I'm doing my part.
Now, here's the thing to know about hedge funds. All of them are constantly competing against each other, and the mark of hedge funds are typically super aggressive investing strategies because they're using the money of the richest people in the world, gathering it all together and trying to out-invest all of their competitors. So when hedge funds lose a lot of money because of these aggressive tactics, of course their investors are gonna leave and go somewhere else. Melvin Capital and Light Street Capital, which both had huge bets against these meme stocks, are down 45% and 20% on the year collectively, which is obviously completely unsustainable and is going to cause major ripples in the market.
No one. Community. I haven't been that entertained since the stock market crash of 1929.
So, like I said, even though White Square is the first fund to shut down in the wake of this massive change in the market, I don't think it will be the first, and I think there's a lot more change coming. So, like I said at the beginning of the video, even though White Square Capital is the first to make major headlines for shutting down in the wake of this meme stock battle, I don't think it'll be the last. Of course, everyone at the hedge funds are scrambling to readjust their strategies and figure out how to regain their capital, but you have to remember it's one of the most viciously competitive fields in the world, and these funds that are losing a ton of money are just gonna get swallowed up by other competitors. These funds that are still open, like Melvin Capital and Light Street, but have suffered major losses throughout the year, have received billions of dollars worth of investment from other hedge funds basically trying to take them over. With this much money, this high of competition, and this much consolidation of power, it's a vicious cycle where smart long-term investing strategies aren't enough to satisfy investors. So instead of using typically successful long-term investing strategies like buying undervalued stocks and holding them for a long time, hedge funds are forced to also take more aggressive risks by shorting companies that they think are overvalued for a short-term gain. But of course, this introduces a ton of more risk into the situation. So when they're wrong, they fail big and other hedge funds come in, invest their money, and basically swallow them up. We saw this back in 2008 when major banks and investment firms failed because they were instituting shoddy investment practices to try to inflate their returns. This led to fewer and fewer hands having more and more power, and I think we're gonna see the same as a result of this meme stock frenzy.
Wall Street loves to use confusing terms to make you think only they can do what they do. Or even better, for you just to leave them the fuck alone. So here's Margot Robbie in a bubble bath to explain.
Basically, Louis Rainieri's mortgage bonds were amazingly profitable for the big banks.
So what are some lessons that we can take away as everyday investors from seeing these massive hedge funds, super smart people with tons and tons of capital starting to really feel the pain and ultimately fail? The first thing that's abundantly clear is that there's a massive amount of over leveraging in the market. Borrowing money right now is super cheap, and retail investors and hedge funds alike are taking advantage of this by borrowing money to invest. This is great when everyone's making money, but ultimately at the end of the day, somebody's gonna be wrong, and the consequences are gonna be way worse if it's someone else's money that you're losing rather than your own. Many of these hedge funds are digging themselves so deep in the hole that they're forced to close, but the same thing applies to retail investors. There's a lot of talk on these forums online about borrowing money. Borrowing money to invest is easier than ever, but it's a really dangerous practice and it's really easy. And if you're not careful, you'll end up just like one of these hedge funds that digs themselves so deep in a hole using other people's money to invest that it's impossible to get out of. But unlike a hedge fund, you probably don't have a friend with $2.7 billion that's gonna come back and save you when you lose loaned out money because of risky investing. The second thing I think we can all take away from this is that long investing is much more profitable over a lifespan than short investing. Betting against a stock failing is so much more risky and has been proven over time to be less profitable than buying a stock with some fundamental analysis that you believe in and holding it for a long period of time. It's much easier to get it right in the long term than it is in the short term, and it's much less consequential when you buy something with your own money and own it for yourself rather than borrowing something for someone for a short period of time and hoping to sell it back later for more. One major narrative that's come out of this whole fiasco is how much money hedge funds have made in the past by shorting stocks. And one potential consequence of focusing so much on that is that retail investors like you and me might think, hey, maybe we can make a quick buck off of shorting a stock. And while of course none of this is financial advice and all of this is for entertainment purposes only, I think we can all take a lesson from these hedge funds about short selling and how dangerous it really can be. The third thing that I hope everyone takes away from this video and this entire situation is that it's really important to educate yourself about what's going on behind the market. It's easier now to invest than it ever has been before, but as it gets easier on the front end and as more people get involved, which are all amazing things, we're seeing that there's a lot more behind the scenes than the finance and investing industry was really willing to admit before. People and institutions are borrowing shares that don't even exist, borrowing shares that have already been borrowed multiple times. There are major conflicts of interest between major parties involved in the stock market, whether it be governments, regulatory agencies, fintech apps, clearing houses. There's a lot more going on behind the scenes than it seems like at first. So educate yourself, take some time to learn about where your money's going when you're investing it so that you stay in control of your invested money and ultimately your financial future. A lot of people are learning a lot of really expensive lessons right now, and I hope at the end of the day, we're all better investors for it. So thank you guys so much for watching this video. Make sure to throw a like down below, subscribe to the Wall Street Survivor channel, comment down below which hedge fund you think is going down next, and I'll see you guys in the next video.